Hello and welcome. This is the Insurance ProBlog Podcast, episode 431. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
That's right.
The internet is full of options, and we are your favorite. Thank you very much.
Replete with podcasts about life insurance.
Yeah. Oddly, we're not joking.
Sure we
You
are.
think so, but that's one of those times that, nope, they exist. Lots of them. We try to be in the top 10.
Yeah. Hey, we're closing out. We're getting close to 13 years doing this.
Yep. Which sounds impressive, maybe.
Yeah.
Pathetic, more so.
Just stop there. Yes, it's impressive. It's impressive. I mean, the most impressive part is just
people still come and say, hey, I found you on that
years?
podcast. I love it.
Who does anything for 13 years?
Well, we do.
Yeah, evidently. So today, what are we? We're going to talk about something totally new and exciting, right?
We're going to talk about all the ways you can design whole life insurance.
Well, I don't think we've ever talked about that before.
We haven't. Not in this fashion.
Okay.
We have 13 years of experience spinning one subject into 13 years worth of podcasts. So
It's a crazy looking mind map.
if you're wondering what we're number one at, truly,
Yeah.
now you know. The idea or the notion here is that there are other people on the internet, let's say, who will tell you that there's an if this then that aspect to setting up a whole life policy.
Right.
Like, if you're doing this, then this is the way you should put a whole life policy together. And if you're doing that, well, then there's this other way you should put a whole life insurance policy together. And while it's not wrong on its face, there's a little too much categorization, shall we say, about it.
Yeah. Well, I was going to say there's a third group of people that just talk about how much they hate whole life insurance, and they describe a policy that basically wasn't designed at all.
Yeah, right.
So they built their entire foundation of hatred of whole life insurance around a false premise, basically.
Mm-hmm.
Because in our minds, no one would buy a policy that was structured that way and or sell one. But
which would be kind of like you and I. Yeah. Which would kind of be like you and I saying, well, here's how much investments in mutual funds suck after you pay the 8.5% load fee and pay the 1.5% ongoing 12B-1 fee. Look how terrible it is.
Right. Exactly. That's only part of the story. So,
yes.
Yeah.
Yes.
So to me, and I think a lot of people, I try to put myself into people that are listening shoes. When you say design whole life insurance, that sounds like a marketing gimmick.
I think it makes it sound special, but okay.
But my point being, it just sounds like an odd premise to start with. But
yeah.
What I think we're going to do over the next 20-something minutes is describe to you what that means and why it matters.
Yeah. So years and years and years ago, when I started in this industry, somebody once mentioned, and it sounded hokey then, probably going to sound a little hokey now, but there's some truth to this, that whole life insurance is really, it's putting it together is like weaving tapestry.
Ooh.
There's a whole lot of optionality that you have when it comes to how it comes together.
Yep.
And if you know what you're doing, you can weave a beautiful masterpiece. And if you don't, well, it maybe looks like something that you'd hang on the refrigerator for a weekend or two.
Yeah. Exactly.
So the robustness to it, the versatility of it, it really means that there is a lot of customizability.
Yep.
And so we get a little wince-y like when people say, well, here are the X amount of ways to design a whole life policy. Because no, there's nuance to this. And I understand the attempt for simplification in broad categories to try and get people a starting point. But I think there are a number of times that leads individuals down the wrong road of thinking, well, because I think I most closely match up with this category of how to do it, that then becomes what I want.
Right.
And I've met a lot of people who found out that's not what they wanted.
Yep.
Let's start with a very, very basic premise when it comes to life insurance design as expressed through death benefit.
Mm-hmm. Mm-hmm.
Because it is life insurance, most people are thinking death benefit.
Right.
There's a trade-off. There's a trade-off between how much death benefit you will get versus how much cash value you will get.
Meaning
that if you want a lot of death benefit at a relatively low expense to you, like money you will have to pay every year for the policy, that can be done, but it will be done at the sacrifice of the cash buildup component of the whole life policy.
Right. Yes. That is 100% true.
Alternatively, if you want really good cash value because you're buying this thing as a infinite banking style idea, or you look at it as another asset to hold or an income tool, then we're going to sacrifice a lot of death benefit for the sake of building as much cash value as possible.
Right.
So the two sit on opposite ends of the spectrum, and you kind of got to decide which one you want.
Yep. I think we've said this before, but the problem to some degree is when people get into trying to merge those two purposes together and create one. And that was a lot of the training that I got early in the business was kind of how you balance that out to create one. I'm not saying that's how they explained it, because that's not how they explained it, but effectively that's what we were doing, was trying to present policies in a way that sort of balanced the two. And what I discovered, and I think you discovered the same thing, what that means is you kind of don't do either one very well.
Yeah. Yeah. So we've been asked on a number of occasions from people, well, okay, they come to understand they're either going to try to optimize cash, or we're going to try to optimize death benefit. And people ask, well, what if I want to be somewhere in the middle? And my answer almost all the time is you don't want to be somewhere in the middle.
Right.
Like, you legitimately want to choose.
Yep.
Now, look, when you're optimizing cash value, one thing that will tend to happen long term is you'll end up with some death benefit. And
you'll get substantial growth in the death benefit over time.
Yeah, and it's possible that may grow into a death benefit that's quite meaningful.
Right.
But it also means that you may sacrifice that meaningful death benefit if you actually want to use the cash.
Right.
Which plans may change, you may not, but you really want to choose one or the other. And something people don't think much about is, well, if you're coming at this with two different objectives, I got X amount of dollars to put towards this, and I really want to be somewhere in the middle, you could just split it up into two policies.
Yep.
And you could buy one that's really focused on cash and one that's really focused on death benefit.
Right.
And if you really want to be in the middle, that's probably what you want to do.
Mm-hmm. Mm-hmm.
So,
and because, I mean, sometimes I know we've done sort of combinations of things for different people depending on their circumstances, but sometimes there are other types of permanent insurance.
Yep.
That will provide a permanent death benefit, much like whole life insurance does, at a lower cost to whole life insurance. So there are times that someone needs to cover both purposes. Our point has always just been, let's do it in the most efficient way possible.
Yeah, right. So if we're splitting it into two policies, it may not be two whole life policies.
Right.
It may be a whole life policy for cash, and it may be a type of universal life insurance for the permanent death benefit, if that's what you're really going for, on evaluating it as what's the lowest cost I'm going to have to actually write a check for each year to get X amount of dollars of death benefit.
Exactly.
That is certainly true.
Mm-hmm.
And, we've commented before that life insurance policies oftentimes come with a specific objective in mind. So there are whole life policies that are intentionally constructed to give you low cost death benefit relative to the premium that's being paid. So they're not good cash accumulators. They don't generally earn a lot of dividends. But if you need $500,000 of permanent death benefit, there will not be another whole life product out there that will give you the same death benefit relative to the premium that you're paying every single year.
Right.
And if that $500,000 death benefit is really what matters, and you want that for as little money out of pocket as possible, that is the way to do that. At least with whole life insurance.
Yes.
Alternatively, there are whole life products that are intentionally designed to build cash value. There are some that are designed to build probably too much cash value in the beginning. We'll put a pin in that and get in that in a few minutes. But those policies are generally what we would use to do all of the fancy manipulations that we have commonly talked about to put in force a cash-rich whole life policy for whatever your intended objective is behind building up cash inside a life insurance policy is.
Right.
So there will be a much stronger dividend payment on that. There will be even more flexibility in terms of the design. Didn't mention earlier that those death benefit focused whole life policies, there may not be as many options on the table to do the stuff that we generally need to do to make it a cash richer policy when it's a death benefit designed or death benefit intended whole life policy.
Well, you're typically not going to have as much premium dedicated to paid up additions riders with a death benefit focused. Yeah, if you even can at all.
Yep.
Right.
So, generally, just to give some people a zoomed out sense of the common makeup, so they kind of understand what they're looking at if they're looking at a whole life proposal for the first time. The stuff that's much more death benefit focused, it's going to have very little to zero cash value in the first year. It's going to pay very little to zero dividend for many, many years.
Right. Yep.
It generally will have a paid up date of age 120.
Yep.
And the whole idea behind that is the later the paid up date, the lower the premium can be each and every single year. So this isn't necessarily a best bang for the buck net cost long term, but it is the best bang for the buck when it comes to how much I'm going to have to take out of my pocket and give to the insurance company.
Yep.
On the cash value,
I would say bang for the buck depends on when you die. So, not to be morose, but
it's true. It's true. No, on the cash value side, there's a lot more nuance, a lot more different pieces that can be going on. And the frustrating, I think, for the consumer is the fact that the way that Mass Mutual does it is not going to be the same way that Northwestern Mutual does it, which is not going to be the same way that Penn Mutual does it, which is not going to be the same way that Guardian does it. So when you think you have an understanding of whole life insurance, it may only be an understanding at one specific company.
Yep.
And then when you try to evaluate whether or not this other proposal is a good idea, a lot of people start to get confused because it's all different.
Yep.
There are, though, certain things that you might want to look at to at least get a sense of, is the design right from a cash-focused perspective?
Mm-hmm.
This would be like, how much of the premium is comprised of paid-up additions?
Yep.
Again, the correct amount is going to differ from company to company, but in general, at least 50% of it should be paid-up additions, ideally more. Another really good zoomed out sort of evaluation is how much cash value does it tell me I'm going to have at the end of the first year?
Right.
And I would tell you, shoot for something close to 70%, maybe a little more. Mm-hmm. Some cases going to be a little less. It's not the end of the world. But the one kind of blinking warning sign to give you is this is not necessarily a case where more is always better. Because if you're looking at a proposal that shows you're going to have like 90% of your first year premium available as cash value, you might be looking at what's called a high early cash value product. And those sound really appealing on their face, but they are pretty terrible long-term cash value rate of return options.
Yeah. Because generally what they're doing is just spreading the expense out over a longer, the higher expense ratio, basically. It's not called an expense ratio for those listening, but I'm just using that generally because I think people can understand.
Yes. Yep.
Yeah. High early cash value products, we've talked about this before, but generally speaking, were created for the corporate market. So,
Yep, they were. They were never designed to be long-term cash accumulation plays. They were designed to cover the liabilities created by certain compensation packages, usually given to very special employees.
Yep.
That the company's trying to retain by having an additional fringe benefit.
Yep.
And the high early cash value is a way of not putting too much of a strain on the balance sheet.
Yeah.
By virtue of the purchase of life insurance to cover the liability that was created by that benefit to that employee.
Right. Yeah. I mean, if you could put $100,000 in premium but carry $85,000 on your balance sheet, obviously that looked more gooder. That's official.
More gooder.
Some companies way back in the day, they actually used to call it a balance sheet product.
Yep, they did.
No one does anymore.
No.
Somehow they figured out the consumer level, and for many years those high early cash value type products. Some of them actually call themselves high early cash value, but a lot of them don't. They were not even available to the individual market.
Still the case to this day for some companies.
Yeah.
Like you can't, as an individual, just go buy one. You have to own a business and show to the insurance company that you're buying it to cover the liability of one of these sort of compensation plans.
Right.
Which, to go off on a tangent that we don't need to, but will because it's us, those products don't have to make sense long-term rate of return wise on cash buildup, because the company that's buying it doesn't need it to make sense from we put dollars into this and we're expecting cash to come out of this, because the benefit that they are providing the employee is whatever it is. And as long as the life insurance policy can create the funds to make that happen, it doesn't matter to the business, because they get made whole when the employee typically dies or cashes out.
Yep.
And then they get back whatever it is that they expended to do this. Plus, there's all of the benefit that they extracted from the employee while hired.
Yes.
So
exactly.
It's a much more complicated evaluation of rate of return than just, well, dollar in turns into this many dollars 10 years out. So it's way more nuanced.
It's not as cut and dry as an individual.
Mm-hmm.
I would agree.
So getting out of that, let's talk about a very favored internet buzzword when it comes to life insurance, whole life insurance, especially. Front loading.
Front loading.
Yeah.
Just dump all your money in there.
Yeah. Just take all of it, put it in there right now.
Well, you should go back to listen to last week's podcast, and that'll give you some background as to why that doesn't work all that well anymore. Used to work great back in the 70s. Not so much nowadays.
Right. So the common dilemma that,
first of all, we should say you can do it.
Yes, you can.
Okay.
You can.
Now we're going to tell you why you shouldn't, but you can.
So the common dilemma is, let's say you've been reading up about this whole life stuff. You like the idea. You've got a bunch of money sitting in the bank. And so you say, I would like to buy one of these policies, and I would like to put $10,000 a year into this policy.
Mm-hmm.
At the same time, I have $150,000 of cash that I would like to put in there right now.
Yep.
The problem when it comes to whole life insurance in general, but this is somewhat more problematic on the whole life side, is we need a certain amount of death benefit to accommodate the money that's coming into the policy.
So it's not to create a modified endowment contract,
as we covered last week.
Yep.
And if it's a big sum of money relative to the ongoing premium that you're planning to put into the policy, it creates a problem, because that death benefit becomes counterproductive to the buildup of cash value in the whole life policy.
Right.
So we don't want to do that. For that reason, when people come to us,
because that's going to reduce your rate of return on cash.
Yeah, correct, exactly. If it's even possible to put it together in the first place, right? Like there could be a situation where it's so much money going into the first year, you couldn't possibly set yourself up in a position where you could put $10,000 in the policy each and every single year after that. The minimum amount of premium that would be necessary is much higher than that.
Yeah.
So oftentimes, if somebody has a lump sum of money, we need to break it up. And we need to break it up into potentially several years, depending on how much difference there is between the lump sum and the amount of money the person plans on planning to put into the policy for an extended period of time.
Yes.
Now, this is entirely different, also known as not the same as somebody who says, well, I got $150,000. I want to put that into whole life insurance and nothing else. What can you do?
Right.
That's a totally different set of circumstances where we can work around that. But to front load with a big lump sum into a whole life policy with the intention that there's going to be some amount of money that goes into the policy indefinitely, that's a lot harder to do. And quite frankly, not always a great situation for whole life insurance.
Right. I think in most cases that we've had like that, we converted the person from thinking I'm going to do this all at once to maybe I'll do this over 3 to 5 years.
Yep.
So I'll split that 150 or that 200 or that 500 or whatever that sum is. We'll split it up and deploy it strategically over a short period, a relatively short period of time, but not all at once.
And quite honestly, this is also one of those times where, yet again, it might make sense to own 2 policies.
Right.
So there might be a very short pay policy that you'd take with the lump sum. And then if you're planning on putting $10,000 a year into a policy, that's just something else.
Yep. So does this work better with a universal life product?
For the lump sum or the front loading idea, it can. It totally can. Universal life insurance is far less affected by this because universal life insurance doesn't have all the design aspects of paid up additions and such. We can start a universal life policy with sufficient death benefit. We do have to be careful about that because that can become counterproductive as well. But we have more flexibility and control over continuous reductions of death benefit with universal life insurance.
Yeah.
So
like
we could
if someone was planning, like they were going to do, just to use your scenario, like 150 and then 10 a year after that, they could do that. And as long as they kept it to that 10 after some period, we could lower the death benefit.
Yep. So we could get rid of what would be unnecessary death benefit for the purpose of cash. And that would put us in a better position. I don't necessarily want to give the impression that 10,000 a year and 150 as a lump sum in year one would be a great idea for universal life insurance either, but it certainly has a much better chance of working out than would ever be the case for whole life insurance.
Yes. Agreed.
In my mind, a lot of the time, there's a number of questions people aren't asking when it comes to, hey, I've got X amount of dollars, here's what I want to do.
Right.
Because I know I spend a decent amount of time when people do that saying, okay, love the gumption, but from my vast experience with whole life insurance, I can tell you that's not what you want to do with the money.
Right.
Here is the other execution of the dollars to make it work out better.
Right.
And it's odd, but we've run into a number of people who don't have that conversation with other agents, and they instead have these weird cobbled together attempts to match what this person dictated.
Right.
And that's not a particularly good situation. And the other thing that does sometimes come up, and it's important to understand this, the marketplace for whole life policies that build strong cash value is extremely small. Like the number of companies, the number of products, we can count it on one hand.
Yep.
And we don't even need all 5 fingers.
I was going to say, we don't need all 5 fingers even.
So it's just not a huge basket of options. But
and
what does happen
in the last 20 years has just gotten smaller.
It has.
Whole life insurance is a very difficult business for insurance companies. I don't mean just for agents. It's a difficult business for insurance companies because of capital requirements, et cetera, et cetera. But
it's not something you just get into.
No, that's probably why everyone doing it's more than 100 years old.
Yep. So there also can exist, given that small pool of insurers, a situation where this is what I want to do, but really nobody lets you do that.
Right.
Until you find this one obscure little company that says, we'll do it. And that's something I want to seriously call a timeout on.
Mm-hmm.
And just point out that when you're buying whole life insurance, you're making a very long commitment to an insurance company. And some companies, even though it's a small number, do whole life insurance extremely well.
Yeah.
And they're the only ones.
Yep.
If we're working with someone else who's not quite as great, but they've got some little quirk about some product that they offer that will accommodate some idea that you have, you might want to think about just changing your idea.
Yep. They could end up like a company in the Midwest that decided they didn't want to be a mutual anymore. And
there are some companies that did have some weird angles on whole life insurance that decided for whatever reason they didn't want to do that anymore.
Yeah. And
it turns out that crazy idea you had didn't work out in the end.
Right.
And it just, I remember years ago, there was somebody who had talked to a certain company that doesn't like nonsense about a whole life purchase. And the proposals showed like amazing cash value in the first couple of years. And he brought this to us and asked us what we thought. And I said, well, I don't think it's going to work that way. And I think when it doesn't, what they're going to tell you is, well, dividends aren't guaranteed. But here's what I would do. I would consider giving them the money with the intention that you're just going to surrender this thing in a couple of years. And it might work, it might not work. But that would be as big a commitment as I would ever want to make to that situation. And just chalk it up as if you can't get a better rate of return than that anywhere else in that short a period of time, do it. If not, don't do it. And sure enough, that company is not much in the whole life business anymore.
Yeah.
So there is a strength to the longevity that some of the better names have. And there's a reason why they don't do some of the exotic stuff.
Yeah.
Because it turns out it just doesn't work with whole life insurance when it comes to the commitments and the obligations that insurance companies are going to find themselves in when it comes to whole life insurance.
Right.
So good agents can certainly direct people on that. People like us.
Yeah.
Who been doing this for decades, written lots of policies.
Yep.
And we too can count on one hand the number of people who have bought policies from us and canceled them. And we don't also
That's
need
true.
5 fingers.
No.
So whether it's a 4th of July accident or a bad woodshop accident, you can still tally them up.
Yep. That's true.
So when you buy whole life insurance, it's not something you can go buy directly from the insurance company.
No.
You're going to need an agent. So you got to find somebody you can trust. And that's just the way it's going to work. And I think there are a certain type of people who want to try and understand everything.
Yeah.
It's very hard to do with whole life insurance. You and I understand a lot, but it took a long time to get to where we're at.
Yeah.
And we were deeply, deeply, deeply in the middle of it all day, every day.
Yes.
If this is something you're reading about.
I mean, the tough part is because we've had other agents, ask us over the years, like, where did you learn? And I'm like, it's a trial by fire sort of place. Like there's really no training class I can point you to or anything like that.
Nope. It is an experience thing. So you can't expect to understand everything, especially if you're trying to do a couple hours here and there after work.
Yep.
To get to speed on whole life insurance. Not unless you're planning to make your purchase like 5 to 10 years from now. That's just the way it's going to go.
Yep. That is true.
So I don't have anything else.
All right. Sounds good.
We'll call it there. I'm Brandon Roberts.
And I am Brantley Whitley.
and we will see you next week.